All right, folks, today I'm back with another video. And this is due to a question that someone asked me just yesterday, in fact. And the question was, what's the better way to invest? Is it dividend investing or is it my simple five fund allocation that I've been using? And I said the answer was that I really didn't know, so that I was going to go and do some research on it and come back. I have nothing against dividend investing. In fact, I did it for a long time. And I even signed up for a service to help me screen for dividend stocks. And it worked, but it was a lot more work than I liked. And part of the reason that I'm moving to my current allocation is that I wanted something that was more hands-off, basically just rebalancing once a year. I didn't want to have to check to see whether or not the individual companies that I've been investing in on a dividends basis has reduced their dividends or cut it back or whatever, any of that stuff, because that's basically work. And there's nothing wrong with it, and it's not particularly hard, but it's just an extra level of complexity that I didn't want. So I moved away from dividend investing and went to my kind of index fund, risk parity inspired allocation. And that's where I'm currently sitting at. But the question is an interesting one because I did it before and I'm interested, so I wanted to look. So let's get to the computer and figure out what's going on. So I looked at this in two ways. The first thing I did was I went to this site, which used to be drippedinvesting.org. I think that was the URL, but they've since changed their looks and all that. But at least one of the tools that they provide is still around, which is this Dividend Champions Excel spreadsheet. So they update this on a regular basis, and then you can download it. And that's exactly what I did. So when I go into the spreadsheet, and I'll try to zoom in here so you can see it better, it gives me a couple of tabs. So down here you have champions, contenders, challengers, so on and so forth. A dividend champions is a company that has paid and increased its dividend for 25 years or more. That's the important bit. Contenders are 10, challengers are some other categories. And as companies increase their dividends year over year, it gets longer on this list. So one of the things I did was I took the list and I sorted it by number of years, which is this column, to see which company has paid and increased their dividends the longest. So if you didn't raise it or you cut it, that doesn't count. And what you can see here is that some of these companies are pretty big companies, and they've been consistently increasing their dividends for a long time. So for example, Genuine Parts Company have raised their dividends for 66 years. That's a long time. Procter & Gamble, P&G, 66 years as well. You have 3M, 64 years. You have Lowe's, 61 years. Johnson & Johnson, 60. Coca-Cola, 60. Colgate-Palmolive, so on and so forth. So I sorted it by longest to least. And if we scroll down here, the lowest should be 25 years because I think that's the cutoff. And I scroll too fast. So here you go. That's the lowest. So these are relatively new companies that came onto the champions list. And as they consistently raise their dividends, they'll continue to be on the list and their numbers will go up year after year. But I didn't look at yield or anything like that. I just sorted it by the company that has been increasing their dividends the longest. There are also some other data in here that's really useful if you are into dividend investing. Let me scroll all the way back up. So in some of these columns here, this DGR 1, 5, 10, whatever. DGR just means dividend growth rate. So DGR 1 year means that this company, American States Water Company, has increased their dividends in the past year by almost 9%. This is DGR 3 years. This is the dividend growth rate over 3 years is 9.72. The 5-year growth rate is 8.76. And the 10-year growth rate is 9.59%. So, this company is actually pretty good. It's been raising its dividends for the last 69 years or whatever it is. And their 10-year dividend growth rate year-over-year growth has been 9.59%. That's pretty good. We moved down here to Parker Hannifin, and their 10-year dividend growth rate has been 11.57, so even better, right? You get down to Lowe's, and they've raised theirs by 19.52. This is not the return on the stock. This is the growth of the dividends that they've paid out. And when you combine it with how many years they've been increasing dividends, that's pretty good. So that was one of my screening for just picking a bunch of dividend stocks to test against my simple allocation. The other was to look at a very popular dividend ETF. So this is the Schwab dividend high yield dividend ETF. So this is SCHD. So it's Schwab US Dividend Equity ETF. And all I did was I went down to the holdings here. I expanded it to see what they were holding and looked at their top 25, basically. So you got Verizon, Texas Instrument, Home Depot, Cisco, BlackRock, Lockheed Martin, so on and so forth. But many of the same companies that are on that champions list, right? Schwab's got their own criteria for selecting the companies as well as the weightings that they give to these companies in their ETF. But SCHD is a popular one for dividend investing if you didn't want to buy individual stocks. Okay, so if you were interested in dividends but wanted to go with a simple approach and don't mind paying a low expense ratio, this one's only 0.06%, so that's pretty low for an ETF. You could buy this, and it's been very popular. So let's go ahead and take a look at how this back tests compare to my simple allocation, and we'll see if it's a viable approach. I'm going to tell you right now, the long and short of it is that it depends on if it fits your style. If you go back longer, I'm not sure how it compares. I may do that in another video, but on this back test, it goes back about 18 years, which I think is long enough. So let's go ahead and take a look at what I did here. Using Portfolio Visualizer and the portfolio asset allocation backtest, I went ahead and enter 100% VTI. So this is total stock market, 100%. And then in portfolio 2, I put in my portfolio, which is this 4-fund, 50% in large cap stocks as represented by NASDAQ 100, long-term treasury bonds, gold, and then my REIT, which I'm using Realty Income. And then for the dividend stocks, portfolio 3 has the top 20 of the dividend champions in equal weight. So I just took the top 20 based on this dividend champions list, which I ranked solely by how many years the companies have increased their dividends, and looking at nothing else, not the growth rate of the dividend, not the yield or anything like that. Just how long have they increased their dividend. And I took the top 20. So AWR down to CWT, okay? And I filled that in here. So AWR down to CWT, there were 20 of them, so it's 5% each. The other thing that I assumed was that we started with basically nothing, so $1. Portfolio Visualizer doesn't let you put in zero amount to start. So $1 is as close as we're going to get, and that's fine. And then I said we're going to contribute a fixed amount on an annual basis, and the amount that I put in was $12,000. This is $1,000 a month, and you can scale it up or down as needed. You can cut it in half to represent roughly an IRA contribution if you want, but I did $1,000 a month just for simplicity, and rebalance annually. So went ahead and click Analyze, and what we see is that the result comes up for January 2005 through January of 2023. So this is 17, 18 years, something like that. Pretty long, not bad. What was holding this back was the gold ETF. If I can find a good gold substitute for the back test, that goes back longer than 2005, I'll be really happy. But here we are, 100% stock market. My four fund risk parity inspired allocation. And then the dividend portfolio, which is 20 stocks, 5% each. All right, let's get down to the results because that's what we care about. Because we're adding money to this test, you can't just look at the CAGR, although they're very close. At the end of the day, and the balances are within a couple of tens of thousands of each other. Not a huge difference, but they're in the same ballpark. So again, my portfolio is 100% stocks is the first one, and the dividends is the last one. And we can see that on just the raw final balance, the dividend portfolio does give you a little bit more. It's almost $100,000 more. And then you have these other rate of returns. And I haven't done this before where we contributed money to the back test. So let me explain some of this. This first one is called the time-weighted rate of return. And the second one is the money-weighted rate of return. And it's basically the annualized return either over time or based on the amount of money that you put in. And typically, what I like to take a look at is the time-weighted returns. So this one right here. So my portfolio gives you almost 11%, not quite 10.89. The dividend portfolio gives you 11.17. Okay, so they're close, but this difference over time contributes to this final balance difference. In terms of max drawdowns, that's the other thing that we care about. Is the max drawdown for the dividend stocks is slightly higher than mine. Mine was just under 27% max drawdown. Dividend stocks is just under 32. You have to decide for yourself if this difference makes up for the difference in return. But basically, if you have higher risk, you're going to get higher return. And you can see that in the standard deviation as well. So my risk parity inspired portfolio has lower volatility as measured by standard deviation. But, not crazy less, but it is definitely less and measurable. So when you look at like the Sharpe ratio, which is supposed to tell you how much return you're getting per unit of risk, this risk parity inspired portfolio does come in at the highest, but this one's not that far behind. The 100% stock market didn't do too badly, but the difference is that the volatility is the highest, but also the max drawdown, right? 51%. And that's what we're trying to avoid. And it also has the lowest Sharpe ratio because the drawdown is so large. So that's the result for using the dividend champions list. The other test that I did was just to take the Schwab SCHD ETF, and I took their top 25 holdings and equally weighted, so 4% in each. And then the rest I left the same. So here's my portfolio in two, the risk parity inspired one. And then for portfolio one, instead of doing a 100% total stock market, because we already know what that's going to do, I changed it up slightly to be a variation of my portfolio, but also something that one of the finance blogger, his name is Karsten Jeske, he recommended from earlyretirementnow.com. He recommended this allocation where you have 60% in total stocks, 25% in bonds, and then 15% in gold. I'm not sure if he uses long-term bonds, but for this comparison, I think I left it like that. I really think he suggested intermediate, but let's go ahead and just change this to intermediate and see what the result is. Otherwise, it's just using the Schwab's ETF holdings rather than the dividend champions. All right, so here is the result. By the way, the Schwab dividend ETF has a lot of overlap with the champions, 3M, Coke, whatever, right? So you're not losing out, but they do pick their holdings using their own criteria. We don't know what it is, but it seems to work for them. Anyways, on to the result. And it looks like same time frame, so that's good. Make sure that I did the same thing here. On this one, I didn't do contributing a fixed amount. So let's change that just to make it even to the other analysis. So we'll start with $1, contribute a fixed amount. It's 12,000, so 1,000 a month. Adjust for inflation, annual contribution, rebalance annually. All right. And both have dividends reinvested. So that's the important key here. It also happens to be the default in Portfolio Visualizer, so that's great. Okay, this is going to look better. So again, my portfolio is running about 923,000. This dividend portfolio is returning a lot better. Again, this is using the Schwab SCHD dividend ETF picks, and it's returning more than $100,000 more in the final balance. On a time-weighted return, it's also doing better, but the reason for that is pretty simple. And I don't know if you can see it, but it's because of the drawdown, 43% max drawdown. Okay, standard deviation is a lot higher compared to the dividend champions. Let me go back to dividend champions. So dividend champions, portfolio 3, has a standard deviation of 1337 for a max drawdown of just under 32%. Whereas the Schwab pick, standard deviation was 1450. This is almost as much as 100% stocks that we saw on the first analysis. Okay, 1573. Not quite as high, but close enough. And that's why the drawdown is so big. So bottom line, you have to decide what's important to you. Will dividends work? Sure. The champions is probably the easiest one to do because I'm just sorting it by how many years have they raised dividends and picking the one that have raised their dividends the longest. Could one of those companies drop off the list? Yeah. Is that extra work? Yeah, that's not crazy extra work, but it's some extra work that you have to check and make sure that it's on your list. Using the Schwab pick, you get higher returns, but you also have higher risk. And the other thing is that we just have no idea the criteria that Schwab is using to select their dividend payers. But it seems to work for them, so I will give them that. But play with results. Dividend investing, if you look at total returns and are reinvesting your dividends in quality stocks, can provide just as good a long-term result. I switched because I didn't like to hold 20 companies, right? You also have the risk that one of these companies can go bankrupt. To be fair, that would be very small for dividend payers because they're value stocks. They've been around for a long time, especially the companies on the champions list. The risk of them actually going bankrupt is pretty low, but it's not zero, right? When you're in a 4-asset kind of index fund ETF, that risk is dramatically minimized. So there you go. I hope that answers the question, and I hope this video was helpful. I'll catch you on the next one. Later.